Most people think you need a W-2, a boss, and 2 years of tax returns to buy a rental property. That is what the bank wants you to think. That is what keeps most people on the sideline while other people quietly build portfolios. Today we are going to break that open completely. By the time this is done, you will know exactly what a DSCR loan is, how it works, who qualifies, what the numbers need to look like, how to find the right lender, and how to structure your first or next deal using this exact tool. No W-2 required, no tax returns, no explanation of why your Schedule C looks the way it does. We are going from zero to ready. Here is the roadmap. First, we cover what a DSCR loan actually is and why it exists. Then we get into who it is built for. After that, we walk through the exact qualification criteria: credit, down payment, reserves, all of it. Then we run real numbers on a real deal so you can see how this works in practice. Then we cover the lenders you should actually be talking to. And we close out with the mistakes that kill deals before they ever close. Let us get into it. What a DSCR loan is and why it exists. DSCR stands for Debt Service Coverage Ratio. That is a fancy phrase for one simple question. Does the rent cover the mortgage? That is it. That is the whole concept. The lender is not asking how much you make at your job. They are asking how much the property makes. If the rent coming in is enough to cover the debt going out, you have a deal. The loan qualifies based on the property's income, not yours. Now, why does this loan exist? Because the traditional mortgage system was built for W-2 employees. 30 years ago, most working Americans had one job, one employer, and a pay stub that said exactly what they made. The mortgage industry built its entire underwriting model around that. But the economy changed. People run LLCs. People do contract work. People flip houses, run Airbnbs, collect rents, and some months write off so much on their taxes that on paper they look broke even when they are not. The traditional system fails those people even when those people are excellent credit risks. DSCR loans were built to fill that gap. They came out of the non-QM lending space, non-qualified mortgage, which just means loans that do not follow the standard Fannie Mae and Freddie Mac guidelines. These are portfolio loans held by private lenders and institutional investors who are willing to underwrite on different criteria. DSCR loans have been around for a while in commercial real estate. What changed is that over the last several years, the single-family and small multifamily rental market exploded, and lenders followed the money. Now you can get a DSCR loan on a single-family rental, a duplex, a triplex, a fourplex, even short-term rentals in certain markets. This is a legitimate, widely used product. We are not talking about a predatory loan or some fringe product. Major institutional lenders use this. Private equity uses this. And now the everyday investor can access it too. Who this loan is built for. Let me paint you a picture of exactly who benefits from a DSCR loan. You are self-employed. Maybe you run a landscaping company, an HVAC business, a trucking operation. Your revenue is real. Your lifestyle proves it. But your tax returns show a net income that your accountant worked hard to minimize because that is literally their job. You walk into a conventional lender and they laugh you out of the room because on paper, you made $60,000 last year. A DSCR loan does not care. It looks at the property. Or maybe you are a W-2 employee, but you already own rental properties. You have 3 rentals, and the rents are all reported on your Schedule E. Conventional lenders start counting that income and those liabilities in ways that hurt your debt-to-income ratio. Your DTI gets blown up even though the rentals are actually cash flowing. A DSCR loan sidesteps your personal DTI entirely. Or maybe you are a newer investor who left your job to do real estate full-time. You have been doing it for 18 months. Conventional lenders want 2 years of self-employment history. You do not have it yet. DSCR does not require it. Or you are a tradesperson, plumber, electrician, welder. Good income, good savings, Maybe some overtime that makes your pay inconsistent year to year. You have the money for the down payment. You found a solid rental. DSCR gets you in the door. This loan is also used heavily by people who buy through LLCs. If you are building a portfolio and holding properties in an LLC for liability protection, conventional loans become almost impossible to use because conventional lenders typically require you to borrow as an individual. DSCR lenders are comfortable lending to LLCs. In fact, many prefer it. The exact qualification criteria. Now let us get into the actual numbers because this is where most people get confused. There are 5 things a DSCR lender is looking at: the ratio itself, your credit score, your down payment, your reserves, and the property type. The ratio first. DSCR is calculated by dividing the gross monthly rent by the total monthly debt payment on the property. That debt payment includes principal, interest, taxes, insurance, and HOA if applicable, what the industry calls PITIA. So, if a property rents for $2,000 a month and the PITIA is $1,600, your DSCR is $2,000 divided by 1,600, which is 1.25. Most lenders want a DSCR of at least 1.0, meaning the rent at minimum breaks even with the debt. The better lenders want 1.20 or higher. Some will go below 1.0. They call it a DSCR under 1 or a no-ratio loan. But you will pay for it with a higher rate and more down payment. Aim for 1.20 or better when you are shopping deals. That is your target. For credit, most DSCR lenders want a minimum of 620 to 640. But do not just aim for the floor. Your interest rate is going to be dramatically better at 700 or above. At 660, you might be looking at a rate that is a full percentage point higher than what someone at 720 is getting. On a $250,000 loan, that is real money every single month. Get your credit score up before you apply if you can. Pay down revolving balances. Do not open new accounts. Check your report for errors at annualcreditreport.com and dispute anything that is wrong. Down payment. This is where DSCR diverges most from conventional loans. Standard DSCR loans require 20 to 25% down on a single-family rental. On a 2 to 4 unit property, it might be 25 to 30%. There are lenders offering 15% down, but those deals come with higher rates and tighter ratios required. Plan for 25% as your baseline. That is the number that opens the most doors at the best rates. Reserves. After closing, lenders want to see that you still have money in the bank. Typically 3 to 6 months of PITIA in reserves. So if your monthly payment is $1,500, they want to see $4,500 to $9,000 still sitting in an account after you have paid your down payment and closing costs. Some lenders count retirement accounts at a percentage of their value. Know what counts before you assume you are covered. Property type. DSCR loans are generally for investment properties only. You cannot use a DSCR loan to buy your primary residence. Single family, 2 to 4 units, condos in certain projects, and short-term rentals in some cases, all eligible depending on the lender. Short-term rental DSCR loans are a growing niche, and some lenders will use Airbnb or VRBO income data to calculate the ratio instead of traditional lease rents. That market is moving fast. Real numbers on a real deal. Let me walk you through an actual example so this clicks. You find a single-family rental in a mid-size Midwest market. The purchase price is $225,000. Comparable rentals in the neighborhood are going for $1,800 a month. You are putting 25% down, which is $56,250. Your loan amount is $168,750. At a DSCR loan rate of around 7.5% on a 30-year fixed, which is a realistic rate in this environment for a borrower with a 700 credit score, your principal and interest payment is roughly $1,180 per month. Add in property taxes, let's say $250 per month, and insurance at $120 per month. Your total PITIA is about $1,550 per month. Your DSCR is $1,800 divided by $1,550. That is 1.16. Some lenders will approve that. Others want 1.20. You might need to negotiate the purchase price down slightly or find a property where the rent-to-price ratio is a little stronger. This is why you run the numbers before you fall in love with a property. Now let us look at the cash flow. You are collecting $1,800. Your PITIA is $1,550. That is $250 per month before vacancy, maintenance, and property management. That is thin but not dead. If you self-manage, you might net $200. If you hire a property manager at 10%, $180, you are at $70 net. That is not a home run. That tells you that particular market and that particular price point may not pencil well at current rates, and that is useful information. Run the numbers. Let the math tell you if the deal works. A better deal might be a duplex where both units rent for $900 each, $1,800 total, on a $175,000 purchase price. Now your loan is smaller, your PITIA is lower, your DSCR is stronger, and your cash flow is real. The DSCR framework forces you to be a better investor because it makes the income the center of the decision. Lenders you should actually talk to. DSCR loans are not at your local bank or your credit union. You are not calling Chase for this. You need to be talking to non-QM lenders and mortgage brokers who specialize in investment property lending. Some of the major players in this space right now include Vizio Lending. They are one of the most well-known DSCR-focused lenders in the country, and they have been doing this for over a decade. Kiavi, formerly known as Lending Home, is another one with a strong digital process and competitive rates. Deep Haven Mortgage is a non-QM lender that brokers work with heavily. Griffin Funding is known for being accessible to newer investors and has competitive DSCR products. Lima One Capital focuses on investors and has DSCR products alongside fix and flip. New Silver is another one gaining ground, especially with investors who like a tech-forward experience. But honestly, the best path for most people, especially when you are starting out, is a mortgage broker who works with multiple non-QM lenders, not a retail loan officer at a big bank. A broker who specializes in investor loans can shop your file to 10 different lenders and find the one that best fits your credit profile, property type, and DSCR ratio. Ask specifically if they work with non-QM products and investment property loans. If they start talking about Fannie Mae guidelines for your self-employed income situation, find someone else. Mistakes that kill DSCR deals. Last chapter. These are the mistakes I see kill deals or cost investors real money. The first one is not understanding the rate environment. DSCR loans carry higher rates than conventional owner-occupied loans. In a market where conventional 30-year rates are around 6.5% to 7%, DSCR loans are going to run 7 to 8.5% or higher, depending on your credit and the ratio. That affects what deals work. Too many people underwrite at a rate they saw advertised in a headline and then get surprised when the actual rate comes in higher. Use current actual quotes from actual lenders when you run your numbers. The second mistake is over-leveraging too fast. DSCR loans make it easy to scale because each property qualifies on its own. That is the beauty of it and the danger of it. Just because you can buy 3 properties in 12 months does not mean each one is a good deal. The ratio can be technically satisfied while the cash flow is anemic. Each deal needs to stand on its own and make sense at today's rent levels, not projected future rent levels. Third mistake is ignoring seasoning requirements. Many DSCR lenders want the property to have a lease in place before they will close, or they will use an appraiser's market rent estimate. If you are buying a vacant property and trying to close a DSCR loan, you need to understand how that specific loan